All right.
Take this. The Bank of Canada dropped their interest rates. This is exciting.
Oh my God, Justin, you are the best.
It's a celebration.
It's a celebration.
It's a celebration. 2020. We've been waiting for this. No?
Yeah, we've been waiting for a drop. Canada's been waiting for a drop.
This is for the Canadian people.
Well, Justin's really excited today.
I didn't think this through.
I wasn't sure whether you were more like the sparklers were more because we were going live on YouTube or because of the 25 basis points.
I mean, that too. And I've picked pink for gay pride as well. So I'm inclusive.
That's great.
Yeah. Well, welcome to Make Money Count. We're doing our first ever YouTube live stream. And it's on the day that the Bank of Canada has dropped their interest rates by 0.25%. And we're going to talk about it. We're going to talk about what it means. We have some cool graphs that Marcus can chat about. And we're just going to have fun with it.
Yeah.
We're going to have fun with it.
So I think the first thing we can start by talking about is that the bond market was certainly pricing this in. And our normal indicator, the CDOR TMX predictor, was not. Right. So the CDOR TMX had, which we commonly show, I don't know, Austin, if you can pull that up for us and put it up on the screen. But the CDOR TMX, up until last night when I looked at it, was showing a 34% chance of a rate drop today. But the bond market had been moving kind of pretty consistently over the last 3 days. So much so that people would ask me about it and they would say, like, what news has come out to indicate this level of certainty that we're going to see a rate drop? I didn't have an answer. And I think that what we're seeing is the Bank of Canada obviously believes that they've got inflation under control, and they maybe are starting to get a little concerned about the Canadian economy.
Right.
There are other indicators that we can look at, and we're going to look at today, that will show us that even though that CDOR TMX market wasn't pricing this in, there are a lot of other indicators showing us that we're going to see rates come down now over the next 12 months.
Right.
Which is going to be great, hopefully, for the Canadian consumer. It's going to be great for anyone that's borrowing capital. So we got our 25 basis points.
We got it.
So what does that mean now for the average Canadian consumer?
Well, I mean, depending on what type of mortgage you have, this is going to dictate what your net rate is. So if you have a variable rate, congratulations, you're finally seeing some, what's the word? Relief. Some relief. Yeah. If you so a big question that I have, and I was really excited about this because basically, just so everybody knows, when the overnight rate drops, the prime rate adjusts, and people with variable rates, their net rate, so when you get a rate of, say prime -1, your rate went from 6.2 to 5.95 today, right now. A lot of people have questions about, well, I'm getting a fixed rate, my mortgage is going to close soon. Does that mean my rate is 0.25% lower? And that's not the case. The market moves with the market, but we do have an interesting chart today that talks about, the fact that some rate drops are already fixed or priced into the fixed rate market. So I'm excited to hear more about that.
Yeah, sure. Well, why don't we pull that up, Austin? So a little while ago, I was talking about a researcher. His name's Alex, and he goes by Axelan on Substack. And I love the research that he produces.
I don't even know what Substack is. So
it's like OnlyFans, but for like
nerds.
I don't know about nerds, but like
joking.
It's like where you would you pay a subscription to see research that's being done and articles that are being written by people.
Interesting.
And you support them with those subscriptions, just like your OnlyFans account.
Yeah, exactly.
Yeah. So yeah, OnlyFans for nerds.
Okay, yes.
But anyways, if you can support him because he's doing amazing work. We've been in discussions to start getting some graphs that we really like and we think that will be of benefit to you, our viewer, our listener, anyone that's digesting our podcast, however you're taking it in. And I think that this is kind of a continued effort for us to show you each time we come to you real information and real data. Like, I get it, we're entertaining and we can provide anecdotal evidence on what's going on in the marketplace, and we can provide kind of heuristically what we think is happening based on all the information we read. But if we can provide you with really great data and graphics surrounding what we think is going to happen. I think it kind of that information helps to empower the consumer and allows you to make more informed decisions about your mortgage, your finances, your investments. And that's the goal here. That's the goal of Make Money Count. So this is an incredible chart, and I want to explain it to you. So before today's announcement, so before a 9:45 announcement of a 25 basis point drop, this illustrates the historical differences between the 5-year fixed rate in Canada and the 5-year variable rate. So the blue line shows you exactly how the 5-year fixed rate has moved from 2006 until today. And the solid green line shows the historical difference between a 5-year fixed rate and the variable rate. So if you follow the solid thick green line and the blue line through that chart, you can see that historically the variable rate should always be, on average, between kind of 60 to 90 basis points lower than the fixed rate, right? Variable rate should be lower than the fixed rate. The light yellow line shows you exactly how the variable rate has moved over that same period of time. So shows you kind of the deviations from the norm of a variable rate mortgage. So just to kind of further illustrate this, you can see on that chart kind of in 2008, before 2008, there was a period where that light green line came very close to touching the solid blue line. That means that at that period of time, variable rates and fixed rates were about the same. But typically, the light green line, which is the historical behavior of the variable rate mortgage, has been lower than the 5-year fixed rate. So you can see it moving through. You can see that there are certain instances, like if you look at kind of 2019, 2020, the variable rate goes actually above the 5-year fixed rate. And you can see that there are other instances like in 2010, when the variable rate is sub 2% and the discounted 5-year fixed rate is a little bit above 4%. Now, what I want you to pay attention to is what happened from 2022 until today. From 2022 until today, the variable rate spiked up, right? Spiked up to the point where you can see it kind of flatlining at 6%. So these aren't like fake rates, right? These are insured best possible interest rates that you can get on the market. So that's showing you a prime minus 1.2% variable, which would be applicable for like purchases under $1 million, insured eligible refinances or switches, transfers, not, and we talk about this way too much, not like the old portfolio insurance products that get a premium applied to them. So that we're kind of comparing apples to apples here. But you can see the deviation before 9:45 a.m. today was 1.73%. 7 rate cuts need to happen in order for the variable rate mortgage to come in line with its historic relationship to the 5-year fixed rate mortgage. Okay. I am a big fan of reversion to the mean, right? Reversion to the mean just means basically there is a kind of normalized standard for how things behave over history, and things always revert back to the mean. Kind of coincides with my saying of the new normal is
bullshit. Are we going to get cut off YouTube for that? Hopefully not.
I think you're allowed to swear on YouTube.
Yeah, I'm sure it's fine.
Anyways, put the chart back up for me, buddy. Thank you, Austin. So as of this morning, before 9:45, we had 7 rate cuts to normalize the relationship between the variable and the fixed rate. What happens in that is as we start, and you're already seeing it with bond yields, as we start to bring down that variable rate, the market starts to get a little bit more confident, and we will see fixed rates start to recede even more, which may require variable rates to come down a little bit more. Go to the next graph for me, Austin. Now, this is really great, right? Like, so anyone who right now is thinking about making a decision as to whether or not they're going to take a variable rate or a fixed rate, you need to know what's going to happen with some level of confidence over the next 2, 3, 4 years. You don't want to take a 5-year fixed rate today, and we've been talking about this a lot. You do not want to take a 5-year fixed rate today when all indications point to interest rates coming down, right? And to further evidence why you shouldn't be taking a 5-year fixed rate, you can look that even now, after this 25 basis point reduction, we've got it modeled in here on this graph. Thank you again, Alex. We still have 6 rate cuts to go to normalize the relationship between the variable rate and the fixed rate. So as much as you may have banks selling you on taking a 5-year fixed rate right now, you have to listen to yourself and you got to listen to the information because it's not in your best interest.
Yeah,
the reason why banks love to sell you a 5-year fixed rate interest rate is why?
Because they're going to blow you out of the water in a couple of years on a penalty.
Yeah. Interest rate differential penalties.
Yeah.
75% of all mortgages break before maturity anyways. And more mortgages break before maturity when there's downward pressure on interest rates. Because Canadians have locked into a 5-year fixed rate. Let's say you're locking into a 5-year fixed rate now at 4.89, 4.49, 4.79. And you think it's a great rate and it's going to stabilize things because the variable rate is still, 5.95 or 5.75, still higher. Eventually, in a year or two, when the variable rates are 90 basis points below the fixed rates and that relationship is more normalized, you will be clamoring to break that fixed rate mortgage and you will be charged interest rate differential, which means that you will be kind of paying the bank for any interest that they will lose by not having your mortgage.
Right.
And that's going to get scary and Canadians are going to get pissed off about that. So we kind of want to help you navigate this environment now because now is the time when you're going to be successful in negotiating that product and setting yourself, your family, your finances up for the future. So this is a great chart for that very reason. Again, just so that you understand it. And if you want access to it, we'll post it. And you can obviously email us at hello@cannect.ca and we'll get it out to you. But that solid blue line and that solid green line are the normalized relationships between a 5-year fixed and a 5-year variable. And that light green line, which we're seeing drop 25 basis points today, still has a ways to go. It's got to come back in line closer to that green, that solid green line. So the CDOR market had it wrong. The bond market was kind of moving to having it right because we saw that start to drop. And I think that I don't know that we're going to necessarily see a flood of Canadian consumers rushing into the market all of a sudden now. I think that we have to be aware that having interest rates high for the amount of time that we had them this high for has affected our economy, right? It's affected the consumer in a meaningful way. And all of this is to say that these, for anyone that's out there just saying that once interest rates come down, the market's just going to spring back to life, you're neglecting the damage that interest rates may have done on other factors in the meantime.
The collateral.
In the interim. Yeah. If you erode confidence in the consumer and you erode consumer spending in a meaningful way in an effort to target inflation, dropping 25 basis points now that inflation seems to be more in line isn't going to be enough to bring that consumer back.
Right.
And I think that that's something we got to be cognizant of. I think that you can expect to see more rate cuts. And I think that those rate cuts are going to be predicated on how the consumer responds. So if I'm wrong and the Canadian consumer kind of springs back into the market,
which would be bad.
It will be bad because the Bank of Canada will see economic readings that may start coming in a little too hot. And as a result, they will slow the pace of those rate cuts. So clearly what we're seeing now is the data that the Bank of Canada is reading is telling them that they're not as concerned about that anymore. Hopefully this puts kind of a bit of a floor on real estate prices. I still don't know because we have to see how this kind of massive amount of supply that we're seeing come to the market reacts, right?
I was biking to work this morning.
I know.
Because I'm super healthy. And I noticed while I was biking down the street, it was basically like a forest of for sale signs in Etobicoke. So there's definitely supply.
Yeah, I mean, so that's just a factor of the Canadian consumer not being confident that these rate cuts are going to come fast enough to help them manage what they need to manage.
Right.
there's actually a really great chart that Alex put together for us. I think it's the last one in this series, Austin, if you want to kind of scroll down to the bottom. No, there was one more. Yes. And this comes from the Bank of Canada, and it shows you the amount of savings that Canadians have. So let's walk through it. So the baby blue is the savings before the pandemic. The yellow is early 2023, so first quarter of 2023. And the green is the most recent data from Q1 of 2024. Remember, right? Before the pandemic, the economy was different. And during the pandemic, the government of Canada injected a great amount of stimulus into the economy. I mean, all of the G7 nations injected a lot of stimulus into the economy. That stimulus was absorbed, and a lot of it was held in savings for the consumer. And you can see the difference here. So the number of months of savings that Canadians have across 3 different subsets: renters, homeowners with a mortgage, and homeowners without a mortgage. So renters have now kind of 3/4 of a month of savings, which is better than it was before the pandemic. And obviously not as great as it was, kind of during, after, and when they got all the stimulus.
Yeah, the free money period.
So the savings is eroding, and you can expect that savings is eroding into debt service payments, but it's not eroding as quickly as some of the kind of consumer confidence numbers would have us believe, right? So it is showing us that many Canadians are being quite prudent with their savings right now, which is amazing. Obviously, it shows the disparity between people who are renting, people who have a mortgage, and people who don't have a mortgage. But that kind of 2 months of savings for Canadians that have mortgages is still pretty close to where it was, when we had all that savings accumulated from the pandemic.
Right.
I think that this chart, if anything, maybe is what the CDOR tax market was reading, because they were thinking to themselves, well, that market was thinking to itself, well, Canadians aren't in that bad shape. There's a significant amount of savings still in the market that will allow them to weather high interest rates for a longer period of time.
Right.
I like this chart because it surprised me. Like,
in a good way or a bad way?
It shows I would not have expected that it would be so small a variance, so small a drop over the last 12 months.
Right.
Like I would have suspected that the last 12 months, from kind of Q1 of 2023 to Q1 of 2024, we would have seen a more significant erosion in savings across the board for Canadians. Maybe not in the homeowners that don't have a mortgage. Like that's a really kind of wealthy subset.
I'm surprised at the number for that. That was what I was surprised about, that it's not higher.
The savings is higher?
Yeah.
No, it's not. That is kind of average.
Right.
Yeah. But I honestly thought that we would see a greater difference between what the savings have eroded to.
Right.
But I mean, this is provided to us by the Bank of Canada and Alex, who put this together so nicely graphically for us. Listen, the hope here is that you can make a more informed decision about your mortgage. I think we're going to see more rate cuts coming. Again, It's going to be dependent on the data as we go. I would be surprised if we saw another 25 basis points in July.
That would be a heyday. Yeah.
I think it might be too soon.
Yeah, it's too much
to see a July cut. I think they maybe will wait to see a little bit about how this affects the market. Again, any impact on the market now is going to be psychological, right? We did a podcast a while ago. Do you remember, where we referenced a research report that was done by the central bank in Australia, and it discussed how monetary stimulus played out into a market.
Right.
It showed us that the stimulus kind of was absorbed or impacted the economy over 48 months. And we were analyzing it at the time from a perspective of what are these massive rate hikes going to do?
Right.
Well, now it's the opposite, and we need to start looking at what the cuts are going to do.
Right.
So a rate cut now will have its impact immediately, but it will have more of an impact in 12 and 24 months. So there's all kinds of things whirling around in the Bank of Canada's collective mind right now. Notably how confident the consumer is. Will their spending come back? What will happen with housing prices? And the first reaction that we're going to see is going to be psychological. So does the real estate market spring back to life? I don't think so. I think maybe some demand comes online to help sop up all that supply that Justin saw on his bike ride in today.
Yep.
I think I'll just end it on this. Like, I hope that we don't get back into this blunt force monetary policy mugs game that we're playing, right? Like massive rate drops for COVID, massive rate increases as a response to inflation, and then now go back to massive rate drops as a response to a weakening economy. I think and I hope what we will see going forward is a more measured decrease in the overnight rate. Like, that earlier chart that we showed, 7 basis points or now 6 basis points worth of cuts that we've got in the bank that we should be using. I hope those don't come all at once. I've got a really good buddy of mine who's like incredibly successful developer in the city of Toronto. And I met with him a couple days ago and he said, for sure rate cut in June. And I was still kind of like, well, CDOR market's not showing that. And he said, and for sure, he says more than a percentage point of rate cuts in the next 12 months. Like he's saying that full 175 basis points will come in the next 12 months. And he's saying that obviously because he's got access to different on the ground information that we don't, that I don't, that the Bank of Canada kind of only hopes that they have. But what he's seeing and what a lot of developers are seeing right now is just a wholesale stoppage, right? Like developers are not moving.
I talked to a client yesterday, one of my really good clients.
Aren't they all really good?
They are really good. They're all really good clients. And he said that because he called me because he watched our podcast from the other day and he was like, I just watched your podcast. I just bought a pre-construction, but I'm in my cooling off period. What should I do? And I was like, well, what happened? Like what came about this? What was the idea? And he said that he got something in the mail saying that if he bought a unit that he would get a convertible Mustang and a all expenses paid trip to Saudi Arabia. Those were his benefits to buying this unit. So they're just giving anything away to sell these things for sure.
Really? A Mustang?
Yeah, a convertible Mustang and an all expenses paid trip. He said his options were Cuba or Saudi Arabia.
Wow.
So yeah. Isn't that insane?
I wonder how the lender is going to see that.
Yeah, I don't know.
Right?
He traded it in for a better price on his property.
Yeah, I mean that's the move.
Yeah.
It's interesting.
Yeah,
it's like financing your car with the purchase.
Through the house. Yeah.
Listen, the government of Canada seems to think that there's a massive supply problem with housing. We keep hearing about it. They want to incentivize developers. The government of Canada will be happy with this 25 basis point drop for sure. We also had an announcement today that CMHC is extending amortizations on developments. So new construction rentals, the amortization is going to go to a maximum of 55 years. So it's another way to kind of instigate, incentivize more development.
Even I learned things on this podcast.
Yeah. Stay tuned. This is going to be more and more exciting. We're going to follow how this affects the Canadian consumer. We're going to follow how this affects real estate prices. And our commitment to you will continue to be that every single week that we speak to you, we will not just sit here with sparklers and what are these things called?
Noisemakers.
That's what this is called? A noisemaker? Yeah, like we're going to always have fun, but we're going to make sure that every single time you watch one of our episodes that you feel like you're getting actual information that will help you make your decisions.
Yeah, 100%. And I hope to one day, producer Austin Knopps, have a full John Madden style board so that when you're talking about the graphs, that you can really get interactive. That's kind of what I pictured here. Like when he does the plays?
Yeah.
I think that would be sick. I think that would be awesome.
Well, let's do that next week.
Yeah, let's do it. I'm excited.
All right, listen, thank you very much for joining us. If it's your first time here, please hit like and subscribe. And in the comments, any questions you have, anything you want us to talk about in the future, as always, please just leave them there. Thank you very much for watching.
Bye, guys and gals.